Welcome back, learners. We were discussing the topics which are related to BCOC 136 and we covered the aggregation of income part, and that was divided into two parts. Part A, which I have already discussed with you, which is the deemed income, and now we will be covering the part B, clubbing of income. So before starting the part B, I will just give a recall what we have discussed in part A. In part A, we discussed about what is deemed income and what are the various kinds of deemed income. I will just give a recall what we have discussed in part A. In part A, we discussed about what is deemed income and what are the various kinds of deemed income which are being included in the income of the assessee if the assessee is not providing any kind of satisfactory information to the assessing officer and he is not disclosing the nature as well as the source of such kind of income. And and on all those deemed income, tax is being chargeable and as per the applicable rates which we have discussed in the previous slides, and all those income were the unexplained investment, unexplained expenditure and the expenditure from the Hyundais and the investment on the Hyundais. So on all those income tax is being charged, and he or she, that is the assessee, either he is not included or disclosing any kind of source of income in the books of accounts, they are supposed to pay tax on all those incomes. So all those incomes and the deduction, any kind of deduction which is to be allowed on all such unexplained expenditure, as well as any kind of deduction which is supposed to be allowed on the deemed income is not allowed, because the assessee is not disclosing fully the information which the assessing officer is seeking. So now we will be covering the part B. Part B, we will be dealing with the clubbing of income. So what actually the clubbing of income is? Clubbing of income means that the income which is being clubbed with the income of the assessee. Although such kind of income is not the income of the real person, but such kind of income is supposed to be added with the income of the assessee, and the tax is being chargeable on that as per the applicable rates. So now you can see on the slide that all these incomes are covered under the clubbing of income. First is the transfer of income without transfer of asset. Second is the revocable transfer of asset, which is covered under section 61. Then we have any kind of salary, commission, fees or any other remuneration to the spouse, which is covered under section 64. Then we have income from assets transferred to spouse, which is covered under section 64(1) under section 4. Then we have income from assets transferred to daughter-in-law, which means son's wife, which is covered under section 64, subsection 1, subsection 6. Then the next kind of clubbing of income which is supposed to be added under this topic is the income from assets transferred to a person or association of persons for the benefits of spouse, section 64, subsection 1, subsection part 7. Income from assets transferred to a person or association of person for the benefit of son's wife, which is covered under section 64, subsection 1, part 8. Then we have income to the spouse or son's wife for investment of transferred assets. So all these topics are covered under the clubbing of income. It means any income which is arising from the spouse, any income from the asset which is transferred to the person or the association of person for the benefits of son's wife, or income to the spouse or son's wife, and all these incomes are to be clubbed with the income of the assessee. So, and all those incomes are liable to be taxed as per the applicable rates. So, it means that the assessee cannot hide any kind of income in the name of the family or any kind of income which he can show to avoid the tax. So, we have to discuss the clubbing of income in detail now. So one more thing which we need to cover under the clubbing of income is the income of a minor child. So first we should know who is a minor child. Minor child is a child who is under 18 years of age. So learners should know that if any of the income which is being earned by the minor child, how we have to deal with that under the Income Tax Act, and whether that income would be considered as the income of minor child in the books of accounts, or such income would be considered as the income of the parents, and how the income of such minor child would be dealt with, and how the tax would be charged, whether the tax would be charged or not, and how the tax would be charged. So, if the income of a minor child, not being a minor child, suffering from any kind of disability, and such disability is being specified under section 80U, shall be included in the income of his or her parents. When I am saying the word included, I am talking about the clubbing of income. So, such kind of income should be clubbed with the income of his or her parents. And income includes both which arises or accrues to the minor, and however, there are certain incomes which is not to be supposed to be added or clubbed with the income of the parents. So, two cases are there under this kind of cases. So, first is any kind of income which is accrues or arises to the minor child on account of any kind of manual work which is being done by him or her. So, such income would not be included in the total income of the parents. Then the second kind of income which is not included in the total income of the parents is any income which is arising or accruing to the minor child from any kind of activity which the minor child is doing, from the skill, talent, or the specialized knowledge or experience which the minor child is possessing. It means that if any kind of skill, talent, or specialized knowledge or expertise if the minor child is possessing, and he or she is earning any kind of income which is included or not to be included. So, learner has to keep in mind that such kind of income is not to be supposed to be added to the total income of the parents. So, for example, the best example I can give you here is, for example, the minor child. Suppose a minor child is a very good music instrument player. So, if any kind of income which the minor child is getting from playing such kind of musical instrument, so that kind of income would not be included in the total income of parents. So, one more example we can see here. If any kind of tuition or the counseling which the minor child is providing to the students who are junior to them. So, if any kind of income which the minor child is earning, so that income would also not be included in the total income of the parents. So, we have to keep in mind, the learner has to keep in mind that all these two kinds of income are not included in the total income of the parents. First is any income which is arising to the minor child on account of any kind of manual work done by the minor child, or any kind of income which is being arising or accruing to the minor child out of the skill, talent, or the specialized knowledge or expertise. That income will also not be included in case of total income of the parents. And if the minor child is suffering from any kind of disability which is covered under section 82, that shall be clubbed in the income of his or her parents. So, these are the rules for the income of a minor child, how it is supposed to be clubbed, and what all income is to be clubbed with the total income of the parents. So, there are certain few things also which the learner has to keep in mind, that in case any income of a minor is once included in the total income of either parents. So, first of all, let me tell you whether the income of the minor child is to be included in the father's income or the mother's income. So, in that case, we will be seeing that the income of the minor child would be included in the income of that parents who is having the more of the total income, who is going to pay income tax, more of the amount of income tax in the financial year. So, income of the minor will be included in the income of such kind of parents. So, if the income of the minor is once included in the total income of either parents, any such income arising in any succeeding year shall not be included in the total income of other parents unless the assessing officer is satisfied, and unless the assessing officer is providing any kind of approval for including such kind of income. So, the learner has to keep this in mind, that any kind of income which is arising in the succeeding year shall not be included in the income of the either parents. So one more thing which has to be kept in mind under this income of the minor child is, if the minor child income is included in the total income of any parents, such income or the income of the individual shall be entitled to the exemption in respect of each minor child separately. And there is a rule which has to be kept in mind is if the income of the minor child so included, or if it is rupees 1500, whichever is less, that income is entitled to the exemption. Either the income which is included, income of the minor child which is included in the total income of the parents, or rupees 1500, whichever is less, such kind of exemption is to provided in respect of the each minor child separately. Then going forward, after discussing the income of the minor child, we have to discuss a few more incomes as far as the clubbing of income is concerned. So next is the income from the converted property. So suppose if any individual who is a member of HUV is converting any asset which such HUV without any adequate consideration after the 31st December 1969, then the income from such asset shall be deemed to be the income of the individual. Then such kind of income arising from such asset shall be deemed to be the income of the individual and not of the income of the HUF, because under this case such individual, although is a member of the HUF, but he is converting that asset which is owned by him without the adequate consideration. So it means that if the consideration is missing in such kind of transaction, then in that case that income would be considered as the income of the individual, not the income of the HUF, and that income shall be included in the total income of the transferor, that is the individual. Here in such case, when the consideration is not involved and the asset is being converted which is being owned by such individual who is a member of HUV after the particular date which is mentioned, that is the 31st December 1969, and that income would be included in the total income of the individual, not in the income of the member of the HUF. So it means that individual would be considered as a normal individual, not as a member of the HUF. And suppose if such kind of converted property is partitioned, then the any income which is arising from the any property which is being partitioned, the such kind of income which is arising from the converted property or the transferred property as is received by the spouse of the transferor shall also be considered as the deemed income of the transferor and shall be included in the total income. It means there are two cases under this particular topic, that the income from the converted property or the transfer property. First of all, we have to keep in mind the date which is mentioned under this topic, and then we have to see whether the individual is a member of HUF, and if the individual is a member of the HUF and there is no consideration involved, then such kind of individual has to pay the tax on the total income, because that kind of income has to be included in the total income. And if the converted property is partitioned subsequently and that kind of income which is being received from such converted property is received by the spouse of the transferor, so in that case also that income will be considered as deemed and will be included as in the total income of the assessee, and tax would be payable on the such kind of income, and it will be payable at as per the applicable rates. Then we have one more thing which has to be kept in mind in case of clubbing of income, that is the income from the accretion to assets. And suppose if any kind of income is being arised to the transferee from the property, transferred without any kind of consideration, and such kind of income is taxable in the hands of the transferor. So if an income is arising from the accretion of such property or from the accumulated income of such property to the transferee, in that case the income will not be included in the total income of the transferor. In that case, such kind of income would be included in the total income of the transferee, and that transferee would be liable to pay tax on such kind of income. So we have to keep in mind under this income from the accretion to the asset whether the consideration is involved or not. And if there is no consideration, then such kind of total income would be added in the income of the transferee and tax would be paid by the transferee. Then we have the one more thing, the clubbing of negative income. And as far as negative income is concerned, Negative income means losses. So losses are also called the negative incomes, and since income of other persons may be clubbed in the income of the transferor. So we have to focus on two things again here, transferor as well as the transferee. So suppose the income of transferee is clubbed in the income of the transferor. So in that case, any kind of negative income or the losses shall be taken into account in computing the income of the transferor for such purpose, and thus it may be concluded that for the purpose of clubbing provision, income includes loss also. So whenever I am talking of the clubbing of income, I am not only focusing on the profits. So if there is loss also, that has to be taken into consideration as per the clubbing provisions or as per the Income Tax Act. So as far as the clubbing of the negative incomes are concerned, we have to focus that the profit as well as the losses, both things are being considered. Then we have the Binami transactions. So first of all, the learner should know what is actually the Binami transaction. There are certain situations when the individual or the person, what they do is they enter into certain transaction in the name of any kind of some other person who is actually not the real person. So such kind of Binami transactions, and the person who is involved in such kind of transaction under whose name the transaction is being performed, that person is known as Binamidar. So Binami transactions are such transactions which are being transacting in the name of the other person, not on the basis of the real person. So the real person plays a role behind the curtain. Actually, the person who is being presented and under whose name the transaction is being made is known as the Binamidar. So the main purpose of such kind of Binami transaction is they want to have tax avoidance. They want to avoid tax which is to be paid on such kind of genuine transactions. So what they do is they don't represent the real person, they present some other face who is not the actual person who is involved in the transactions. So in that case, if the assessee officer consider that a particular transaction is Binami, because every time I told you that in the previous slides also, few minutes back I told you that for every transaction the assessee is supposed to provide the explanation to the assessing officer that what is the source of the income, what is the nature of the income, and if the assessing officer is not satisfied, so in the same situation is happening in the case of Binami transaction also, and if the assessing officer is not satisfied with the explanation which is being provided by the assessee, and assessing officer is very much sure that the such transaction is the Binami transaction, then he can consider that such income is a Binami transaction as the income of the real person, and in that case such kind of income is included in the income of the real person and the tax is being paid by the real person. It means that real person who is playing the role behind the curtain is supposed to pay tax, is liable to pay tax as per the applicable rates. Then after the Binami transactions we have cross transactions and the I can say cross transfers. So first the learner should know that what are cross transfers. These are the transfers which are intimately connected by the agreement so as to form part of a single transactions, and each transfer constitutes consideration for the other, and in such cross transfers income shall be clubbed in the hands of the deemed transferor and the provisions of 64 section will be applicable. So for example, which you can see on the slide which I have given, suppose X is an individual who is making a gift to his wife and the amount of gift is rupees 1 lakh, and that gift is being made by X to the wife of his brother Y to buy a house, and at the same time Y gives a gift of some shares owned by him to X wife. So since it is a cross transaction, because the income of X wife from such transaction and the income of Y's wife shall be considered from transfers assets and will be clubbed in the hands of deemed transferors. And here, who are the deemed transferors? Deemed transferor in this particular example are the income of X wives shall be clubbed in X income and the income of Y's wife shall be clubbed in the hands of Y. It means any kind of income which is arising to X wife will be clubbed with the income of X, and any kind of income which is arising to the wives shall be clubbed in the hands of Y. It means even if the income is arising out of gift, that income would also be clubbed, because these such kind of transactions are the cross transactions, because the assessee cannot hide such kind of income which the wives are accruing in their total income. So in that case, that income would be clubbed with their husbands. So in case of X, such income would be included in the X, and in case of Y's wife, such gift income would be included in the total income of the Y. So these are the cross transfers or the cross transactions. Then there are certain things which are being covered under section 66 of the Income Tax Act. So while computing the total income of the assessee, there shall be incomes on which the income tax is being payable, and so in case of section 86 also, the share of an assessee in the income of an association of person or the body of individual of such income. So what are there are certain rules which the learner has to keep in mind, that in case when the assessee income, that is the assessee, here where we are considering the assessee as the association of person and the body of individual. So certain rules are there which we should know. So you can see on the screen there are three kinds of rule which we should know, and the first is if the assessee is a member of AOP. AOP is the association of person, or BOI, that is the body of individual, then the share of assessee in AOP or BOI shall be included in the total income of the assessee. And however, if the AOP or BOI is liable to pay tax on its total income, the assessee shall be entitled to rebate of such tax on such share of income, including any remuneration at the average rate of the income tax. It means if the assessee is a member of AOP or BOI, in that case, the income of the assessee would be included in the total income. So this is the first rule which the learner should know. Then the second rule is where the assessee is a member of AOP or BOI, but such AOP or BOI is not liable to pay tax on its total income. In this case, it means that the AOP and BOI are not paying the tax. So what will happen when the assessee is member of such kind of AOP or BOI who are not paying tax? Then the assessee will not be entitled to any kind of rebate of income tax on his share of income. So it means that in this particular case, the assessee is liable to pay tax on such income, because the assessee who is a member of any kind of AOP or BOI who is not paying tax, in that case also the assessee has to pay the tax on the income which the assessee is accruing. Then the third thing is if the total income of AOP or BOI is chargeable to tax at the maximum marginal rate or any higher rate. So under such situation, the provisions of the Act which are applicable are that the share income of the member assessee of such AOP or BOI shall be included in the total income, and in that case the assessee's share of income from AOP or BOI shall be exempt from tax. So this under the third rule, the assessee is not liable to pay any kind of tax, because his share of income from such kind of AOP and BOI is not paying any kind of tax. He is getting exemption, he or she is getting the exemption, because AOP or BOI are paying the tax at the maximum marginal rate, or we can say any kind of higher rate. So in that case the assessee will get the exemptions. So these are the topics which we have covered today. So today we have discussed about the deemed income, but actually the deemed income is what are the various kinds of deemed income, what are the sections which are being covered under the deemed income, and what are the taxation rates which are applicable for the deemed income. And in the second part we have discussed about the clubbing of income, what are the things which are being covered under the clubbing of income. We have discussed how the income of the minor child is being dealt with as per the Income Tax Act. Then we have discussed about the Binami transactions, and then we have discussed about the various other rules which are being applicable to the income. So thank you so much for today.